We got a 25 basis point interest rate cut last week, as expected, and the stock market has continued to make all-time highs every single day since then. So with that, I wanted to share a covered call play on Robinhood that I think would work really well in the week ahead given the current market conditions and where Robinhood is trading currently. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. The information provided in this video is for informational and educational purposes only and should not be considered financial advice. I'm not a financial advisor and I'm simply showing you my trades and my strategies. So with that said, let's jump in and understand how covered calls work. A covered call is an option strategy where you sell call options on stock that you already own. For this strategy to work, you must own at least 100 shares of a stock to be able to sell one covered call, because one options contract lets you control 100 shares. So when you sell a call option against your shares, you're telling the buyer of that call option that you're okay giving up your shares at a certain strike price that you choose at the time of selling the covered call. So let's look at an example. Let's say you own 100 shares of XYZ Corporation trading at $50 a share. You decide to sell one call option with a strike price of $55 a month out from today. And in return, you collect a premium of $2, which is basically $200 because, again, one options contract represents 100 shares. So you would collect a premium of $200 at the time that you open the trade. So once you open the trade, let's look at the potential outcomes at expiration. In scenario number one, let's assume that the price of the stock stays under the $55 strike price at expiration. Well, in that case, our call option expires worthless and we get to pocket 100% of the premium that we collected at the time that we opened the trade, which was $200. So for scenario number two, let's assume that the stock price equaled exactly the strike price of our sold call at expiration. Well, in that case, there's a 50% chance that our call option will be exercised and our shares are called away. We still get to pocket the $200 premium that we collected at the time that we opened the trade. For scenario number three, let's assume that XYZ Corporation exceeds the $55 strike price at expiration. Well, in that case, our shares are called away and the call option is exercised. Again, we still get to pocket the $200 premium that we collected at the time we opened the trade, and we also pocket an additional $500 from the stock price appreciation, which is the difference between our cost basis, which was $50, and the $55 strike price that we agreed to let go of our shares. So now that you understand how covered calls work, let's take a look at Robinhood and see where it's trading. So I have the 6-month chart pulled up for Robinhood. And right now, Robinhood's trading at the top of its Bollinger Band. For those not familiar with the Bollinger Bands are a technical analysis tool that I use to help me determine when to enter and exit my positions. Generally speaking, a stock tends to trade within the Bollinger Bands 95% of the times. In cases it jumps out of the Bollinger Band, whether on the upside or on the downside, it generally reverts back and comes inside the Bollinger Band few days later. So I'm recording this video on Sunday, September 21st, and looking at the Friday candle right here, Robinhood made an all-time high of 125.18 and is currently at the top of its Bollinger Band. So looking at the RSI, I see the RSI at 71.14, which is basically in the overbought territory right now. And generally, when a stock is in the overbought territory, it means that there is a potential for a pullback in the days ahead. Now, obviously, there's nothing guaranteed in the stock market, but generally speaking, when a stock is trading at the top of its Bollinger Band with RSI being in the overbought territory, there are good chances that the stock will revert back in the days ahead. Now, while this is great from a technical standpoint, we have an additional caveat at play this week, where Robinhood is actually going to be inducted in the S&P 500 before market open tomorrow, Monday, September 22nd. So keeping that in mind, so there is a strong possibility that Robinhood could actually continue to go higher and make a new high tomorrow with the inclusion in the S&P 500. So keep that in mind if you consider this play. Now, I'm recording this after hours on a Sunday, so let's look at the options chain and see what kind of premiums we could get by selling covered calls on Robinhood. So we're going to go out 1 week to the September 26th options chain. And if I look at the expected move right here, right now we have an expected move of about $8 for Robinhood for this week. So if I add about $8 to the current price, we're looking at an approximate strike price of $132. If I look at the $132 strike price, that is a delta of 25. Now, generally speaking, when I sell covered calls, I like to target a delta of anywhere from 15 to 20 for selling weekly covered calls. And all that means in simple words is that there is a 15% to a 20% chance that the stock will end up at that strike price by expiration. Now, keep in mind, the closer you are to the current stock price, the higher the premium that you can receive when selling covered calls, and the further away you are from the current price, the higher the delta. That means the lower the premium that you would collect when selling covered calls. So it completely depends on what your goal is at the time of selling the covered call. If I go with the 132 strike price, I would collect a premium of $1.35, which is actually the mid price between the bid and the ask, and $1.35 equates to $135, which again, one options contract represents 100 shares. So we're simply multiplying the $1.35 by 100, and then we would collect $135 if we went with the 132 strike. Now, why I wanted to bring this trade to your attention is the fact that Robinhood again is trading at the top of its Bollinger Band, and with the RSI being in the overbought territory over 70, that means that there is a potential for a pullback in the days ahead. Now, again, keeping in mind the S&P inclusion and the fact that Robinhood could actually continue to go higher tomorrow at market open, keep that in mind before entering the trade. So assuming that Robinhood jumps at market open tomorrow and makes a new high, what you could do is potentially enter your trade at that point. So looking at the current options chain, if I choose a strike price just a couple of strike prices above the current price of the stock, I would easily double my returns. So for example, if I click on this 126 strike price, again, knowing that Robinhood is at the top of its Bollinger Band and there is a potential for a pullback. And if I go with this price, as you can see right now, that I would actually collect a premium of $450 versus a premium of $135. And that's easily about 3 times the premium that we were collecting earlier, which was $135. I don't believe this would work every week, but in case you have a perfect setup where a stock is trading at the top of its Bollinger Band and the RSI being in the overbought territory, I do believe that you can utilize that setup to double or even triple your premiums selling covered calls on your favorite stock. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching with me, click on the first link in the description below and I'd love to help you out.